Each year, Microsoft Research hosts hundreds of influential speakers from around the world, including leading scientists, renowned experts in technology, book authors, and leading academics, and makes videos of these lectures freely available.
Thank you all for coming to our Wednesday colloquium. It is my pleasure to introduce my good friend and I guess collaborator or near collaborator. We're in we'll be in at least one edited collection together, so that comes close enough. Lisa Servan. Whoa. Lisa is visiting us from Lisa's currently a scholar at the Russell Sage Foundation, and she's most of the time is a professor and former dean at the Milano School of International Affairs, Management, and Urban Policy at the New School in New York. She has written about her earlier work has been about the digital divide. She's written about gender and planning, about alternative economic practices in Barcelona and elsewhere. And now she is hard at work on a book that is due next week,
Monday,
which is titled The Unbanking of America, How the New Middle Class Survives, which will be published by Houghton Mifflin Harcourt. So coming soon to an airport, Barnes & Noble, Kindle near you. I hope. Anything else? I was going to say something else, but I can't remember. Well, anyway, I'm so glad that Lisa's here, and I'm sure you will all get a tremendous amount of interesting stuff from her talk. Yay.
Thank you. Thank you, Lana. Thank you, everyone, for being here. I had originally planned on submitting the book before I did this week here, and the deadline got moved, and I thought it was, my son actually said, are you sure that's a good decision to go when he's 11? And I wasn't sure it was a good decision, but it's turned out to be great because, as you all know from being here, it's a lovely environment in which to work, and I'm staying at a hotel, so I don't even have to do dishes or walk my dog or read bedtime stories. So I've been able to really focus for the last few days before I actually turn this whole puppy in. What I'm going to talk today about is this financial inclusion debate. You may have heard the terms banked and unbanked and underbanked, which are bandied about policy circles. And I'm going to kind of get inside those terms in that debate and actually question whether it's the right way to talk about the problem that we talk about. But I first want to show you a couple of pictures. And in some ways, the first two pictures I show you can sum up a lot of what I have to say. The first one is of a bank on the left that looks a lot like the bank I went to as a kid. I was born in the mid-'60s, grew up in the '60s and early '70s. And even though that's not me in that teller line, that picture really epitomizes a lot of my experience going to Pulaski Savings and Loan in my Polish immigrant town in central New Jersey. And I remember going there when I was a kid with my dad as part of his Saturday afternoon errand rituals. We would go to the post office, we'd go to Mike the Butcher and get meat for the week. My dad would get his haircut at Mike the Barber, and then we'd go to the bank. Mike the Butcher and the Barber. Yeah, they were both Mikes. So not the same guy, though. It was this not a fancy building, but we'd walk across the lobby and up to that teller window. And the teller always knew my father and everybody else in the bank. There would be a bowl of lollipops on the counter. She would ask how I was. They would talk about how the local football team was doing. And it felt like this community space, like all of those places felt. And then when I got my first savings account when I was about 7 years old, I got this passbook. I don't know, some of you are too young for passbooks. How many of you remember getting this? Mine was green with gold letters. And when I got allowance money or babysitting money or gift money from my grandparents, we'd go to the bank and they'd put it in one of those machines that kind of typed in the balance, and I could see it grow and I could see a little bit of interest, and it just felt almost like this rite of passage. So fast forward to today, these are my children, and this is this is one step farther in the process of what banking looks like. Now, for most of us, we don't even use the ATM very often. We use, except to get cash, but that's what my kids think of as a bank, is the machine that you go to and press a few buttons and it spits cash out at you. I don't think they've ever been to a teller window because I go so rarely that when I do go, the teller doesn't know my name. I never recognize the teller. In fact, one of the most recent times that I had to go for a money order, there was a well-dressed bank employee who would approach the people in the teller line and say, "Can I show you how to do what you want to do on the ATM?" You know, trying to get us out of the line so that the transaction would cost less to the bank. Never mind that what I needed to do I couldn't do on an ATM. So in the meantime, while the sort of face of banking has changed, a lot of other things have changed too. And one of them has been the way that we think about banking and who has bank accounts and who doesn't. So back in 2009, the FDIC began measuring who has a bank account and who doesn't, and creating these terms by which they describe all of us, which are banked, which means those are the people in gray, 67% of us, which means you use a bank account and nothing else, or a credit union. So I'm going to use banks and credit unions kind of interchangeably for a lot of this. Or you're unbanked, about 8% of the population, or you're underbanked. Unbanked means you don't have a bank account at all. Underbanked means you have a bank account, but you also use other kinds of services, like maybe payday loans or check cashers. And policymakers really think of this as a problem. They think that it's a problem if you don't have a bank account, that you're missing something really important, and so they've been really focused in terms of this financial inclusion debate on getting everybody who's not banked or who's not completely using a bank to use a bank account. Now, just briefly, it's kind of critical to look at how these statistics differ by race. So you'll see that if you buy into these categories, the picture looks much worse if you're Black or Latino in terms of being unbanked. And to take a little bit of a detour, I just want to show you, since I'm going to be talking a lot about what I call alternative financial services, what alternative financial services consist of. So I'm going to be talking mostly about payday loans and check cashing, which constitute the biggest part of this whole industry. But it's important to say that there's a lot of overlap. So most payday lenders do check cashing. Some of the payday lenders also do auto title loans, prepaid cards you can get at a payday lender or a check casher. Does everyone here know what a payday lender is? I don't know if they're legal. Anybody not know? Okay. So payday loans are very small loans, usually up to about $500, that are due on your next payday. So it's a short-term loan, uncollateralized. So it's 2 weeks or 4 weeks, and they cost a lot. So the place that I worked, which I'll tell you about in a little while, charged $15 per 100 borrowed. So if you took out a $100 loan, you'd actually get $85 back, and that whole $100 is due on your next payday. So, and there's a lot of controversy, as you can imagine, about whether those loans are helpful or harmful. So jumping back to the way that policymakers and consumer advocates tend to frame these debates, this is a very simplistic diagram, but it communicates a lot. Policymakers think banks and credit unions are good and that everything else is bad. But I began to wonder why, if alternative financial services are so bad, why are so many people using them? And I began to ask this question maybe about 6 years ago. I was teaching a course called Gender Development and Finance, and I'd invited a woman who ran a credit union in the South Bronx to come to my class. She asked if she could bring a friend who turned out to be a check casher. It was a guy named Joe Coleman who ran a chain of 12 check cashers in the South Bronx and Harlem. And my students had all read all this stuff about predatory, sleazy, alternative financial services providers, and we were really ready to go to town on this guy. And he came to the class and actually made a very compelling case for why he thought his businesses were providing a necessary service in lower income communities, the communities where he worked. So that got me really thinking, and I started looking at the data on these lenders, and I found that beginning in the 1990s, the businesses really picked up in terms of how much business that they were doing and how much people were using them and even switching from banks. And I began to question the kind of received wisdom that the policymakers were putting out there, because it seemed like if these services were so bad for people, yet so many people were using them, the implication, even though it was never stated such, was that people must be ignorant or stupid if they were making that choice. And I had done a lot of research. I'd been researching low-income communities for 20 years, and that didn't make sense to me. It seemed to me, from my own experience, that low-income people knew where every dime went and were very good about managing it, even though they often didn't have very good choices. So then what are the other theories that are out there? Well, one of them is access. Right? Well, poor people don't go to banks because the banks don't locate in low-income communities. And to some extent, there is validity to that argument. Just looking at where I did the beginning of my research, there's one bank for every 3,000 people in Manhattan and one for every 20,000 people in the South Bronx, where I did the beginning of my field work. So right there, you know that access is an issue. However, if you start walking around and paying attention to these things, you'll find that that's not the only issue. This is a block in downtown Brooklyn, near where I go to the movies with my kids, and you'll see that on the left there's a check cashing store and there's a Chase on the far right on the very same block. And indeed, where I worked as a check casher, there was a Chase Bank about 3 blocks away, and when I went and worked in Oakland as a Payday lender, there were 2 other banks on the same 2-block commercial strip where I worked, and those businesses were not suffering for business. Yes? Oh, sure, I can do that right now. So check cashers, well, they do everything that Payday lenders do. So if I were to draw a Venn diagram, let's see. So here are check cashers. And here are Payday lenders. I think this works. So Payday lenders, actually it would be more like this. Almost all of them do check cashing. But check cashers only do payday loans if they're allowed to. So to make it a little more simple, there are 12 states in which payday lending is illegal. Do you know if Massachusetts is one of them? It probably is. They tend to be on the Northeast. And the reason they're illegal is that the loans are too expensive. They exceed the usury rates. Check cashers take government or paychecks. They'll sometimes take personal checks too, but they charge an awful lot for those, and they actually charge you to cash your check. They also do other things like sending money using Western Union or another service to send money either abroad or within the United States. They sell prepaid debit cards. Where I worked in the South Bronx, we sold Metro cards, stamps, lottery tickets. So they do a lot of things like that. It varies by state. This is one of the really interesting things about this whole industry, is that there's almost no federal regulation. So where I worked in the South Bronx, it was in New York State, it's 1.97% of the face value of the check. It can be up to 8% for a personal check in some places, and in the West, you'll see that they're more expensive than they are in the East.
So just to get the sense,
yeah.
If I were getting paid, say, $2,000 a month, and it was 8%. If I were going to this place, I would be paying $160 a month to cash it. Where if I would be going to this place, like the Chase just around the corner, I would be paying much less, right?
You'd pay nothing if you had a bank account, right?
Yes, a bank account. I mean, I guess bank account, they have like some commissions or.
So you can see why the policymaker would say you should go there instead of there.
Right. So so why do people?
I'm going to get there. I'm going to get. Good question. Did you have another question?
No. Right.
And I'm totally fine with these kind of clarifying questions if you want. Right, so location is not the whole part of the story. Now, so if you do a literature review and you look at what people say about these things, you'll find that the academic literature says they're high cost, unscrupulous, often fraudulent, that AFS means alternative financial services are part of the poverty industry. There are some issues that I would totally take with them. They don't offer savings accounts. They're regulated as something called money-serving businesses and not banks, so they can't take savings. Although, interestingly, as a side note, the place that I worked in the South Bronx actually partnered with the credit union. I mentioned before that the woman who brought this check casher in ran a credit union. And so you could open a savings account at the credit union and deposit money seamlessly into that account from the check casher, which I thought was quite unique. And most people won't go anywhere near, most reputable businesses don't want to go anywhere near a check casher or a payday lender because they fear the reputational risk of consorting with those evil people.
To deposit into their credit union account.
Correct.
Still paid the 1.97%.
If they're cashing a check, but they could, if they're cashing it, but they could simply deposit it if they wanted to do
Zero
that.
transaction fee for that.
Yes.
Okay.
So, and the reason why the credit union would want to partner is that the check casher had a lot more outlets, so it made it more convenient. So they felt like it was a win-win for their customers. So what else? They also talk about, the literature also talks about how use of alternative financial services results from poor management of bank accounts. So there's a lot of behavioral sort of talk about the customers who use these, and their voices are often not really lifted up in the research. As I mentioned before, one of the things that drew me to this topic was that the use of alternative financial services is large and growing, and you really see it happening around the early 90s. Check cashing transactions have grown from 45 billion in 1990 to 58 billion in 2010, and payday lending transactions have grown from 10 billion in 2000 to 30 billion in 2010. Even though payday lending is illegal in 12 or 13 states, there are more payday lending stores than there are Starbucks and McDonald's. You've heard that on John Oliver, maybe, if you saw that particular episode. And so that's pretty interesting to think about how pervasive. So I felt like even though I had done this literature review, I'd looked at the FDIC reports, I couldn't really figure out the answer to your question is, so why are so many people using these? And what I did about 3 years after this man, Joe Coleman, had come to my class was I called him and I asked if he'd hire me as a teller, because it seemed like that was the only way I could get really close to the problem. So I donned a polo shirt with the logo. This is actually the job I took in Oakland. So I worked for 4 months, once a week, so one 8-hour shift a week for 4 months in the South Bronx as a teller at a check casher, and then later went to Check Center in Oakland, California, where I worked for 2 weeks full-time as a lender, basically working the same job as a teller, making payday loans, and then worked for a week as a debt collector in their back office, so calling people who were delinquent on their loans and really trying to understand what was going on for them. To look just at, so the work that I'm presenting today is the culmination of a whole lot of projects that add up to my book. And just to give you, I'm not going to go deep into all of these, but I'm happy to field questions afterwards, perhaps. I call the kind of work that I did embedded ethnography because it was not undercover. The people where I worked knew what I was doing. I did 120 interviews, more than that, with alternative financial services consumers in both of the places where I worked. After I was done with the job, after those months and weeks were over, I kind of went to the other side of the counter and then did one-on-one interviews with people. I did focus groups with groups of millennials because they were kind of a specific group that's experiencing certain kinds of debt. I did an analysis of a subprime borrower database. So you may know that most of us get our credit scores from TransUnion or Experian or one of these big 3 credit bureaus, but there's also a set of subprime credit bureaus that work specifically with these lenders to help them get a sense of who their customers were, and that data set has about 50 million people in it. So we did an analysis of the administrative data, we did a survey, and then a set of interviews with borrowers, payday borrowers, which gave me a different perspective, not just behind the counter for the people who were taking out the loans, but the people who'd taken out a lot of loans. I don't know if I put this up here, I worked for about a month as a volunteer on a hotline called the Predatory Loan Help Hotline, which was run by the Virginia Poverty Law Center, and we helped people who had had trouble paying back their loans to figure out how to get right on them. And then when I realized that a lot of the people that I was encountering and doing these interviews with were also doing a lot of things informally. Informal loans, not just loan sharks, but lending circles. I went back to the South Bronx and spent a few months talking about those informal financial services. So that's basically the the sum of the research. And what I concluded at the end of all this was that the consumer financial services industry is broken and that consumers are misunderstood. So that's kind of the bottom line. But now I'll tell you a little bit more about how I got there. So in contrast to that first diagram I showed you with the two circles, what I realized is that the consumer financial services industry really consists of these three intersecting circles. Mainstream, banks and credit unions, the good guys according to policymakers. Alternative, which includes kind of good guys and bad guys, payday lenders, check cashers, pawn shops, et cetera. And then on the informal side, loan sharks, money guards, ROSCAs are rotating savings and credit associations, and bail bonds. So these were places that people were keeping or moving their money that are pretty much off the radar for policymakers and invisible to most of us. So money guard is someone who informally holds your money for you. So for example, when I did the informal financial services work in the South Bronx, I met a woman named Blanca who runs 2 rotating savings and credit associations. I bet not all of you know what those are, right? Okay. So these are prolific, particularly in immigrant neighborhoods, but I've also noticed them a lot more recently in workplaces where people are not necessarily from the same ethnic or immigrant group. And so what it is, let's say 10 of us get together, somebody leads the group, and we say that everybody's going to put in $100 a week. And on each week in turn, a different person gets the pot. So let's say I'm running the group, and what I get, one of the perks I get for running the group is that I get the first number. So, and I might have a small business like Blanca, my informant did. She had an informal gold jewelry business, and so when she got that money first, it was like a loan, right? Because she's paid in $100 and she's getting $1,000 back. So then Lana's number 2 in line and Caroline's number 3 in line, and you're effectively paying back the loan every time that you give into the group. And the last person in line, sometimes those people like to be the last person because it forces them to save. And not only does it give them some discipline in saving, but sometimes, particularly in low-income neighborhoods and networks, there's a lot of pressure on people not to save money, because once you build up a nest egg, there's a lot of pressure from your friends and relatives to get access to that. And if you've put it in this rosca, then it's insulated and it's safe. There are actually 200 names for these organizations worldwide: tandas, consorcios, sociedades, Ks, and they're all over the place in Asia, Africa, and Latin America. And all of those different groups have brought them to the US, and now they're spreading and becoming more mainstream. So that's super interesting. So Blanca, the woman who ran the roscas that I looked at, also operated as a money guard. So sometimes people would say, like, I got my money, but I don't want to have it yet because I'm worried, my husband gambles and he'll find it and take it, or somebody else will spend it or ask it if I don't have it. So Blanca, even though a lot of those people are unbanked, Blanca had accounts at 2 bank accounts. And so sometimes people would even deposit money for the rosca into one of her bank accounts in order to save informally. So it was this really interesting, if you think about, what I'm especially interested in are these intersecting parts of the circles, right? So, I have some drawings I can show you later if we have time that show how somebody in Blanca's circle is using the mainstream consumer financial services component in order to save informally, which is kind of bizarre, but really interesting. Caroline?
Is there a particular reason why someone might be interested in depositing in one of her bank accounts as opposed to...
Just like bring it to her house? Mostly convenience, or...
As opposed to opening one of their own, right?
Oh, an account?
Yeah.
Well, part of it is that it forces them to save. And believe it or not, one of the reasons that people don't go to banks is that they don't trust the banks. They trust, even though there's a risk of Blanca taking their money, and we found people participating in these groups where that had happened, they're not getting interest, they're not building a credit score, but they still trust the people that they know better, right? So that's a huge, huge issue. So I also found that there were 4 things that the people who came to my teller window really valued, and those are the things I'll walk through right now. The first was lower cost and greater liquidity. So when you hear criticisms of the alternative financial services industry, the thing that you'll hear most is that they're expensive, right? Everybody raised their eyebrows when I said it was $15 per 100 to borrow, or even almost 2% to cash your check. So I was really surprised myself when people told me, I don't go to the bank because it's expensive. Here are a couple of quotes from my interviews. There's a guy named Zeke who said, "I'd like to go back to the bank, but I can't afford the monthly charges." He had been a chef at JFK Airport working in food services, lost his job, and during that interim period between when he lost that job and got another job as a janitor, he couldn't keep up with the monthly charges of the bank account. His balance was so low that there was no buffer. Maria, who's a home health aide, said it was like I just kept paying more and more. And in fact, what you'll see if you look at the growth in fees, you don't have to actually even see the small print on these, except mostly the direction of the trend lines, is that in that period from the mid to late 90s to the present, bank fees have gone up and up. ATM fees have gone up, monthly service charges have gone up, overdraft fees have gone way up. The availability of free checking accounts has gone way down. 75% of non-interest-bearing checking accounts were free in 2009, and only 2 years later in 2011, only 40% of those accounts were free. So that's a huge drop and a huge change in the product that we think of as being pretty standard. The other thing that I found was that it was not only cost, but liquidity. So when you see somebody paying 2% of the value of their check to pay to get the cash, a lot of what they're paying for is the fact that they can get that money immediately. If they deposit that, if they had a bank account and they deposit it into their account, it would take 3 or 4 days to clear. And in the meantime, the bills are due, they need to buy food, and there's no money to kind of float them during that time. So those 3 or 4 days are critical. And I'll tell you a couple of stories that really illustrate that. There was a guy who came to my window. He actually came in pretty often, and that's one of the things you see at check cashers and payday lenders is that unlike banks where we rarely go to the teller window, people come in weekly, sometimes more. So you really get to know your customers and you see what their patterns of usage are. Carlos was a small contractor. You could tell because he would come in his work clothes and his like painted up coveralls and things. And one day he came in and he pushed a $5,000 check under my window. I cashed it and I gave him $4,903 or something like that. And there was, it was like a $97 fee. He took the money, passed a $10 bill back through my window, which was my tip, which is not uncommon. And after he left, this was one of the ways in which I really realized that even though I was coming in and putting myself in this position, I didn't always understand why people were doing what they were doing. So I turned to the teller who had trained me and I said, he's got to have a bank account, right? I mean, this guy is running a small business. He's not among the unbanked. So why is he coming in here and leaving $100 on the table? And with my kind of middle-class assumptions, I thought, he could have taken his wife out to dinner. He could have put it in a college account for his kids. He could have invested in his business. And Christina turned to me and she said, well, Lisa, today is Thursday, which means tomorrow is Friday. Probably his workers are undocumented, because most of the day laborers in New York City are, and he needs to pay his guys on Friday. So if he puts that $5,000 into his bank, it's not going to clear before payday. Or maybe he just got a job, and this was the down payment on the job, and the only reason he got the job is that he can start tomorrow, and he needs to buy supplies. So he could go right to the lumberyard with that money and get the job started. So these are really rational reasons why someone would go to the check casher, and yet it's not without understanding these stories that you can really see it. Another story that illustrates this liquidity issue was a woman who came with her EBT card. We have these electronic benefits transfer cards, and that's one of the things you can do at a check casher is you can swipe the card and you can take money out. So I did that all the time, and then usually it was $63 or $120 or whatever, and it was a $2 fee no matter how much you were taking out. And the day that a woman came in and had $10 in her account, I once again raised my eyebrows and thought, why is she paying $2, which is 20% of what's on her card, to get that $8? And again, I asked one of my coworkers who said, well, you can't get $8 out of an ATM. You can't get $13 or $27 or any odd amount. And she needed every dollar she could get as soon as she could get it. So she was willing to pay a very high price. These are not hidden fees. They're very obvious in order to get every dollar that she had access to right then. Yeah.
Is it correlated to bank consolidation?
Yes, and I'll get to that. It definitely is. So there it is. Why has banking been... She's a plant in the audience. So why has banking become so much more expensive? And there's a lot of reasons, right? One is bank consolidation. And so you'll see that during this period, especially of the 70s and the 80s, bigger banks were buying up smaller banks in a kind of game of Pac-Man. And so a lot of the people I talked to said, like, I used to really like my bank, but it's changed names 4 or 5 times, and I don't even know anybody who belongs there anymore. The other thing that starts happening, and this is also related to deregulation, these 3 bullets are kind of overlapping, they're not mutually exclusive, is that with deregulation that begins in the 70s and goes through the 80s, banks are able to do more. So Glass-Steagall, which you probably heard about it, if you don't know much about it, you still heard about it invoked during the Democratic debates. A lot of people are saying, Bernie Sanders included, we need to put back Glass-Steagall. Well, that was a law that was passed in the wake of the Depression that separated investment and commercial banking. So it really limited what banks could do. And so for this long period between really the Depression and the 70s, banking was pretty boring. Bankers were not ultra rich. In fact, it was called, I was telling Lana this earlier, the 363 era of banking, which meant that you got 3% interest on your savings accounts, you were charged 6% interest on loans, and bankers could get to the golf course by 3 o'clock in the afternoon. So that doesn't really happen anymore. So with deregulation and Graham Leach Bliley and the repeal of Glass-Steagall, they were able then to kind of participate in these risky investments that they hadn't been able to do since the pre-depression time. So suddenly, this commercial banking and customer service was a lot less profitable compared to the other things that they could do. And the attitude with deregulation changes as well, so that whereas before, and if you looked at Louis Brandeis, Supreme Court Justice, Woodrow Wilson, Thomas Jefferson, they all really felt like banking was a part of the public infrastructure, almost like the railroads, and that there needed to be a system for the economy to run, and that bankers had kind of a responsibility to serve people equally well. That changes. So the nature of that government-bank relationship changes from being one where bankers are really supposed to serve people to one where it's profitability and efficiency that are valued more. I had people, when I was doing a lot of interviews with people in Washington, so one of the things that happens during this time is that's when fee income in the 80s starts to really grow. Part of it is because of interest rates being really volatile, and to some extent the government is saying, like, you guys need to figure out a more stable way to make money. Well, bankers then discovered things like overdraft, which they used to hate to do. They felt like it was an inconvenience, but then they suddenly realized that they could make a lot of money out of it. And in fact, I think the last year they made $38 billion in overdraft fees, most of it from lower income customers. So people told, there's an organization called Haberfeld, which is a consulting organization, which basically went around to the banks and said, here's what you need to do to maximize the money that you're getting from fees. People called it the gold mine of checking. Somebody else, a banker, said it's like a drug. Once you get this, it's like a drug. It's addictive. So banks kind of discovered it, and then even the community banks that didn't want to do it felt pressured because that became the business model for banks. So this graph, which is pretty simple, just shows the rise in the number of payday lending stores over the same period, really, which is the blue line. And the downward slope, this is bank consolidation, is the number of banks that have less than $100 million in assets. That's a small bank. The next slide shows the change in the number of banks with more than $10 billion in assets. So right now, the top 4 banks hold about half of the assets in the country, right? So there's been a huge change in terms of the consolidation of wealth and power in the largest banks, and that's a big reason why we have the situation that we're in. I think I covered this already, the bank-government social contract changes. The bank business model also changes, so you get non-banks entering the picture, like mutual funds and things. People started moving their money out of banks in the 70s and 80s to save in different ways. I talked about the greater reliance on fee income and pernicious practices, which I didn't necessarily talk about, but I'll talk about briefly right now. So banks do a couple of different things that are not necessarily in consumers' best interest. One is something called high-low debit resequencing, which means that, let's say you have $100 in your bank account and 3 different things hit your bank on the same day. A bill for $75, one for $50, and one for $125. So what the banks will do, they have a software program that reorders those transactions that are hitting your account, so that rather than having the $50 or the $75 one hit first, which would create 2 overdraft fees, right? They have the $125 one hit first, which gives them 3 overdraft fees, right? So there are programs that do that to maximize how much money they're making from you. They also take money out of your account 7 days a week, but they only put money in 5 days a week. So there are these little things that happen on a routine basis that were not common practices 50 years ago, but now they are. So when Joe Coleman, who was my boss, the head of the check casher in the South Bronx, talked to me, he made it very clear what the difference in the business model is. He said, banks want one customer with $1 million, right? They don't really care about having lots of people or acquiring new customers. Check cashers want 1 million customers with $1. So the very nature in which they make money is very different, right? The banks really want people to put their money there and leave it and not bother them very much, where the check cashers want you coming in over and over again, and they're making a small amount of money on every transaction.
Confused by the banks wanting one customer with $1 million. That customer would never have any overdraft fees.
Well, that's right. But in general, the overdraft fees are kind of the way that they make money off of people who wouldn't make money on anyway, right? So they're really making a lot of their money over wealthier customers who don't bother them very much, right? But it's sort of like, if I'm going to serve you, relatively poor person, the only way I'm going to do that is if I charge you through the nose, right? So, and they actually, they don't do check cashing services. They don't do all of these other things because they actually really don't want those people. They don't feel like they make very much. Mary?
That was going to be my question, but I wonder if you have something that shows a break in terms of how much money they're making off the wealthy patron or wealthy customer compared to the money they're making.
I don't, but I wonder if I could get that data. It would be really good data to get. I mean, you see that all of the big banks have these like Chase Private Client, Citigold, right? They have special services for if you get, say, $50,000 or more. You get a lot of free stuff then, but this middle group and the lower income group doesn't. So let me move on to the next thing, the second thing that people valued a lot, and that was transparency. So one of the things that you may or may not realize when you get a checking account is that you get something called a disclosure agreement. There's like these documents that you click agree on all the time on your computer without ever reading them. Has anybody ever read their bank checking account disclosure agreement? You have.
Well,
Congratulations.
I no longer have a bank.
Well, I should talk to you after, right?
I was leaving Bank of America.
You read it, okay.
Because I had a big fight with them about some fees. But
That sounds like a good story. Okay.
a former regulator, so. I'm not unbanked. I have financial account.
Yeah.
Bank account, yeah.
So anybody have any idea how long these are?
Very.
How many pages?
Aren't they like 6 pages long?
6 pages.
Tiny print.
44 pages long on average. They used to, just about 5 years ago, they were 110 pages, but they've gotten a little simpler. Nobody's going to read that, right? So transparency is a big issue. And, a lot of times regulators say that the answer to transparency is disclosure. But if disclosure means a 44-page agreement, it's not that transparent. And the other thing that's really interesting is to just think about the experience of walking into a bank and imagining that you did not go there as a child like I did with my parents. I can walk into this place and recognize it because I was going there since I could walk. And yet, if you look at it through the eyes of a newbie or maybe an immigrant, you'll see that there is absolutely nothing there that tells you what's for sale, what the comparison between products is. I like to think of the analogy to, say, a store. What if you walked into a clothing store and said, like, I need a pair of black pants? They're going to bring you a pair out of the back, and you have to, there's no ability to really, and if you didn't have the knowledge of what to expect, you wouldn't even know what questions to ask. So even a relatively friendly architectural space can be very intimidating. The contrast is the place where I worked in the South Bronx, Right Check, where it almost looks like a fast food restaurant with the menus, spanning the teller windows, and it tells you in big print that it costs $1.50 to pay a bill, 89 cents for a money order, which is less than the post office charges, 1.97% to cash a check. So you know right there what you're paying for every transaction, and it's very clear. And that clarity and transparency gives customers a lot of comfort that they know how much they're spending. The money's not going to come out of some account on a day that they don't expect, and there's nothing tricky about it. And I saw a lot of people come in with their checks, cash the checks, have that pile of money, and then they would lay their bills out in front of them and apportion the money to the different bills, not always paying every bill in full either. So they would have that money and they would say, like, okay, how much do I have to pay the electric company to keep my electricity from getting turned off? Or how much do I have to pay the phone company to not have them bother me? And I better pay my rent in full, otherwise I'll get evicted. So there was this kind of managing of the money, and whatever was left was how much they had until they got paid again. And that was a very kind of visual and easy way for people to manage their money, and the check casher really helped that. The third thing was better service. This photo, which is a kind of a stock photo from one of the training manuals that I got when I was doing the work that I did, kind of illustrates the way that the teller is supposed to approach the customer. She's got an open and friendly posture. Her workspace is clean. She's smiling. And I went to some customer trainings where I was taught all of these things. So another page out of my training manual, I went to an all-day training at the Payday lender. This was called the hamburger model of customer service. And we were supposed to kind of bracket the transaction with the bun of personal information. And one of the things I noticed immediately when I walked into both businesses on my first days was that the tellers knew the customers by name. And in fact, we were instructed in the Payday lender to use the customer's name 3 times during every transaction. So it was very specific. In fact, the tellers who I worked with at the check casher had both been there for 10 years. So they were familiar faces, people knew them, people trusted them. And there was a much greater effort, I think, to make sure that that customer service was in place, because in general, they're offering pretty standardized services. So the service is the differentiator, and they put a high premium on that.
Yes, from personal experience, it seems like banks offer worse service, but do you know that they don't have similar training and they don't?
I don't know that they don't have similar training, but I can tell you that all I can say is that when people talk to me about their service, they definitely said that they felt like they were treated a certain way here and that they were treated poorly at the bank. And I don't know if that's just, I suspect that it's not just lower income people, although I think my theory is that there was a premium on that kind of treatment in lower income neighborhoods. And that's partly because, think about the way that you all walk through the world. I'm sure you're treated with a fair amount of respect, right? You work in this nice building. They give you free drinks and a nice office. Here I am, I'm being taken out to dinner. I'm staying in a nice hotel. Just because I'm at the hotel, they're very, nice to me, right? Whereas the people who are coming, say, to the check casher have to take the subway, which may or may not always run very well. They're in the New York City Public Housing Authority, which is a bear to kind of deal with. So they're not necessarily, they're probably working low-end jobs where they don't get a whole lot of respect. So if you have a place in your life where you're treated as a valued and respected customer, it means more to you, I think, than, I would say that most people that I know of my sort of status feel like they kind of put up with the poor service they get at their bank because what are you going to do, right? But it doesn't have the same kind of premium that it would.
I suspect you're right in the effect. I think it would be really fascinating to find out whether, like a traditional bank, the teller training has any discussion about customer service, because I wonder if it even is, there's a different notion of customer service that's supposed to be,
could be.
I don't intrude on your personal, there's another
right,
mode where it's
right.
I don't, I simply make the transaction clean and simple. I say hello, I say goodbye, and there's no, like that the other version would actually be seen as intrusive. And that's serving a different audience.
Perhaps, yeah, that's a really interesting question. But I'll tell you one story about how it played out at the check casher. So there's a woman who came in one day who's a Puerto Rican woman in her 50s who had a government check to deposit. And I looked her up on my screen. We had like records for everybody. And this message popped up that I hadn't seen before that said that she needed to pay us $20 every time she came in. And I'd never seen that particular message. So I asked for help. And the woman next to me said, like, oh, Marta, last time she came in, her check was bad. So what would have happened if she'd gone to a bank? They would have sent back the check and probably charged her for that. They would have charged whoever she tried to use the check with if she had tried to write a check from it. And maybe even kind of, you get these black ticks when you do things like that at a bank that can put you into this system called check systems that boots you out of the whole banking system for about 7 years. There are about 1 million low-income people now who can't get a bank account if they want to in the United States because of these systems. So what we did with Marta, so Marta then says, that was her name, she said, I can't actually pay you the $20 today because, so they had made this arrangement rather than kind of booting her out that she could just pay $20 a week every time she came in. And then until the check was made up without charging her anything extra. And she said, I can't do it today. I've had this unexpected expense. So the other teller just pressed a few buttons, cashed her check for the whole amount, minus the fee, and let her go, right? So there was this flexibility also with working with a person's individual situation instead of kind of just saying, these are the rules, I can't do anything, I can't help you. And so Marta's going to leave the bank, and or the check casher, and she's going to say, wow, this place is great. They worked with me. They helped me out. How many of you have ever left your bank and just like come back to work raving about the service you got, right? It doesn't happen very often.
How much flexibility do the individual cashiers get to I mean, because I can imagine working at a bank, there'd be a lot of rules about what I could and couldn't do. Maybe I can't accept a $20.
Right.
$20.
I think, so the woman who was able to do that had been there for a long time, and I think the farther up you go and the more experience you had, you'd be empowered to do some things like that. I couldn't have done it because I was new and I wouldn't have known the consequences. But there's a level of trust, like most senior employees at places. You've all run into those people at the airlines or in stores who can take back something that you returned 32 days past, even though the policy says 30 days, right? So there's usually a way around the rules, but you don't always find it in financial services.
At some point when we talked, I feel like it was part of your argument here that these check cashers and payday lenders were often kind of more like medium-sized chain businesses rather than like too big to fail giant consolidated banks, and that there was more institutional flexibility.
Right. I think that happens, right? So there's been consolidation in these industries, but nothing like what happens in banks. And the fact that they're still making their money off of all these transactions means that kind of service is really important. So how did customers show their appreciation? Loyalty. That was the most important thing probably. You'd see the same people coming back over and over again. Probably, I would say, loan repayment at the payday lender, right? I mean, theoretically, you're more likely to pay somebody back when you have a relationship with them, when they know you by name and know where you work and when you go on vacation. And also these tips. I mentioned the tip I got from that car contractor. $10 was a lot, just to say, but some of the tellers I worked with could make $40 or $50 a day in tips. People would know how we took our coffee and bring coffee in for us in the morning. The woman who trained me was very pregnant when I came on board, and after she had her baby, people would just drop off baby gifts and ask how she was. So these kinds of things were happening that made it a certain kind of community space that I wouldn't say I've ever seen happening at a bank.
How long that had been a practice, how standard and just how established that was, as the tipping particularly, but...
Oh, they said, I mean, certainly since the tellers that I'd worked with were there, which was 10 years, So it was just really, the first time it happened to me, I didn't know what was happening, and I was like pushing the money back, and then they were pushing into me, and I thought, no, I counted right. And I got fewer tips because I was new. I was also, the neighborhood I was working in the South Bronx was mostly Spanish speaking, and I'm not Latino and Spanish. I speak Spanish, but it's not my first language, so I think people would look at me and go like, I'm not sure if I should trust her or if she'll speak my language. But once people kind of got to know me, then they trusted me too. So I think it was really, people saw it as like, you gave me good service, I'm going to give you a little something back. But it was a pretty standard practice. Not everybody. There was certainly I don't think people felt obligated to do it the way you might in a restaurant, but a lot of people did tip. Some people that I interviewed used the language of family. It's like we're family. We know all of them. We know all the tellers. And people would tell me stories about what that meant to them. So the last thing that that is important is the availability of fast credit. Obviously, this is at the payday lender, not at the check casher. And there have been changes in credit markets that have happened at the same time and since these other changes of deregulation and bank fees going up, et cetera. So over the course of this period, definitions of what's good and bad debt have shifted. It used to be that good debt was only kind of debt that you used to make investments, whether it's to pay for college or graduate school or buy a house or something like that. And over time, it's been much more acceptable to use credit cards and things to pay for everyday goods and services. And so there's been a bleeding of what good and bad credit is. And credit worthiness has also shifted so that we see a lot more people who, at least before before the financial crisis, who were qualifying for credit than used to. So the people who could get a credit card, that pool became much broader. In the 1970s and 80s, a lot of states repealed their interest caps, which made payday lending possible, which meant that these lenders could come in and charge a whole lot. And then the availability of use and credit expands. And then it contracts post-crisis. So you had this huge expansion at the same time that you also see other things happening, which I'll talk about in a second, like declining wages and income volatility. And then suddenly the credit gets pulled back and people are really stuck. So this is the drop in the supply of consumer credit between 2007 and 2010. So before and after the crisis, you see all this credit pulled off the market. And that's one of the reasons why you see this huge shift to people using payday loans, because they need the credit and they can't get it anywhere else. So here is, and one of the things that when people think about overdraft fees, they think about it as kind of a fee but not a loan, when in fact, a lot of the time people are using overdraft as a kind of a short-term loan, right? So during the same period, you see both spending on payday loans and overdraft fees going up a lot.
Compared these to credit card fees? Because credit cards are also a form of borrowing, right?
That's right.
And their fees are horrendous.
Yeah, they are. It depends on the fee. It obviously depends on the card, and there are and the interest rates. Yeah. I mean, there's some. It would be a little bit of apples to oranges, just because you can keep a balance on a credit card. But yeah, you could do that comparison. I haven't done it one-to-one, but if you just look even at payday loans and overdraft, so the payday lenders are required to post their APRs, the annual percentage rates, and people get crazy because they're about 400%. But if you turned an overdraft into a short-term loan, it would be about 5,000%. Yeah.
What is the rate at which people don't pay back their payday loans? Could you offer this service at a much lower rate? Well,
that's a really good question. I mean, it depends on the lender. The data's not universally available. I think at least 2/3 to 3/4 of the people that at the chain that I worked at, which was another small chain, I don't know if I mentioned that, about 13 stores in California, paid back their loans on time. But what happens is that a lot of the people take out a loan and they don't pay it back. So definitions even of repayment are a little shifty, because at this particular place, for example, let's say you took out a $250 loan, you had to pay back that loan before you could take out another one. But people would often pay it back and take another one out right away. So it would look like an on-time paid loan, but in effect, it's an extension of a loan. In other places, you can actually roll it over, meaning I'm not going to pay it back, but and when you take it out again, you pay a whole other set of fees, right? So it's the same loan, really, for longer, but you're taking out another set of fees.
What was the fee for
$15 per 100?
$15 per 100. So you
right.
need basically, just to break even, if there is no interest, etc., you need at least 85% of the people to pay it back, right?
Right. But the thing is, it's not so much. It's not just the paying back that makes them the money. It's the fees. So you actually, it's the people who are rolling over those loans a lot who are subsidizing the people who are paying it back right away, right? So payday lenders will say that that's not their business model, right? And this is what consumer advocates get bent out of shape about, is they say you're actually selling a product that's designed to be a 2-week loan that people are keeping out for 3 months or 6 months, right? And so that's where a lot of the controversy comes in. The problem is that there is not really an alternative for many of those people, right? And yeah.
So I just had a thought about like a fifth explanation for why people are doing this, and this is, I mean, my own area of research, so it's obvious I would raise this, but like concerns over surveillance. So people on TANF, for example, like they avoid having a bank account because they're worried about getting rendered ineligible for public assistance because of asset limits, or people
child support,
getting liens on their income so they don't do direct deposit, or like people involved in the criminal justice system, they have legal financial obligations and stuff. You know, 80% of people processed through there have LFOs, and then if you have 50% of black men being arrested by the age of 23, maybe that like concern over surveillance and disproportionate involvement in those kind of like systems contributes to some of the racial.
I think that's some of it. Am I okay? I know I'm like going over on time. Am I okay? Because I'm taking questions and stuff. Are you guys fine?
Yeah, some people may. I didn't realize how close.
I don't have that much left to do, but if I'm gonna, I don't mind taking questions. So I'll tell you just one quick story. After Carlos, the contractor, came in, and I was like scratching my head about why he brought in this $5,000 check. We had a leak in our roof at home, and our contractor came over. And he's got like a pretty big business and trucks with his logo on them and all this kind of stuff. And I said, Tom, like, can you help me understand why this guy would have a check cash? I was like, you don't use check cashers. And he goes like, I have accounts at 3 of them. He says, nobody does their business totally above board in New York. You can't do it with the insurance and workers' comp and everything, And he said the only thing what changes is the contractor's appetite for risk. So everyone is hiding some of their income, and the thing is, it's easier to hide that income when you're at a check casher than it is going to a bank. It's just harder to dig it up and make sense of it. So a lot of people are doing it, and that's another reason, even though they have bank accounts too. So there's this kind of obfuscation.
It's getting like increasingly surveilling though too now. Like now that check cashers take your photo and
we took photos of everybody. But yeah. So at the same time, this is kind of the last piece. This is important to understand, is that while all these changes have been going on in financial services, the context in which people make financial decisions is also changing. And those changes have resulted in a much broader group of people who are using these services. So when I went into this research, I was looking at low-income people in poor neighborhoods, and I quickly realized that it wasn't just low-income people in poor neighborhoods who were using these services and who were living in kind of economically, financially precarious situations. Whoops. So this underserved demographic is expanding. It's because of declining real wages. Income volatility doubled. It's much harder to predict from month to month or even from week to week how much money is coming into your household. There's been this kind of what Jacob Hacker calls the great risk shift, whereas a lot of risk used to be taken on by the private and public sectors, and it's been shifted to individuals. We all know the student debt problem, and what I found actually in some research I did with big data from a subprime borrower is that among payday borrowers, the fastest growing group is what I would call the new non-prime. Groups of people whose credit scores had dropped quite recently in the last year from prime to subprime. 20% of them made over $50,000 a year net. 1/3 were homeowners, and 43% had a college degree. So these are not the kind of people that you think of when you think about doing research in the South Bronx. It's a very different population, which makes this research, I think, and the findings more important on a broader level. A couple of quotes just from people that I interviewed that are illustrative of some of the mood out there. This is a woman who was a master's level student in nonprofit management who had been in the Army, and she was a graduate student. She had owned her home. And she said, I actually managed to make my mortgage even when I was unemployed because I had renters in my house and I was managing to come up with the extra. My credit score was the last thing I let go of. I lost everything else, but I had a 780. That was the very last thing I let go of. Then when I let go of that, I was like, I don't have kids. I never plan on getting married. I never want to buy another house. I'm buying my next car with cash. So yeah, my parents had the American dream. Good for them, never going to be for me, and I don't want it anymore. So it's illustrative of these shifting expectations for younger people about what's possible even with an education. You also saw a dramatic increase in the subprime population before and after the crisis. 17 million people dropped from prime to subprime during that period. So then that means they're getting less access to credit and paying more for the credit that they can access. Another man who is a 57-year-old grandfather in Dallas who had a job as a computer technician for the government, lost it, and then only 15 years later did he make enough money to get to the same level he'd been at before. He ended up taking out a lot of payday loans and had medical debt too. He said, so many things happened, but there's just very limited options. I had to do it because of situations that came up. The problem is if you have to go through non-standard ways of getting that money, you pay such an exorbitant amount and you've probably made it more difficult for yourself to get caught back up. So what does this all mean? I think there's a few things. One is reframing the debate. I think this kind of banked, unbanked, underbanked framework has lived its useful life and it's not that helpful anymore. It also stigmatizes people. And I think we need to shift from that debate to thinking about financial health and financial justice. What does it take to allow a much broader range of people to achieve financial health? In terms of things that can happen, transparency is a really easy fix. There's a lot of innovation out there, but smart regulation is needed to bring that innovation to market. And the other piece is that we really need to address those macro problems about income stability, about the safety net. So many people that I interviewed that were payday borrowers had medical debt, and that's why they were taking out their loans, for example. So those things will be really critical as we move forward. And finally, next January, you'll be able to buy the book, and maybe I'll come back. But thank you so much for your really good questions.